My name is Max Gagliardi, and this is the Talk Energy Podcast. Today's guest is Ashley Zumwalt-Forbes. Ashley is a born and raised Oklahoma native with a bachelor's degree in petroleum engineering from the University of Oklahoma and an MBA from the Harvard Business School. Ashley is the president and co-founder of Black Mountain Metals, where her company is betting big on the raw materials that will supply the future growth in energy storage. This episode is filled with international travels, hostile takeovers, and the savvy business dealings of a young woman executive in energy. Hope you enjoy the show. Ashley, welcome to Talk Energy. Thanks for being on the show.
Thanks so much. I'm happy to be here. Thanks for showing me how to plug in my headset, etc.
There's a lot of technical difficulties that go on. So where I wanted to start, there's a bunch of good content for anybody watching. You've got great content out there. You've got some good interviews. The Forbes thing is awesome. So for anybody that wants to know kind of the origin story or more about why you're doing what you're doing, I would encourage them to go look at that stuff. And for this, I think, what I really like to focus is kind of post-Harvard MBA. You obviously probably had a lot of options. Why Mountain? What drew you there? What did they bring you on initially to do? And then how did you build the knowledge base that got you into the metal side and the mining? And just walk me through that part of it.
So my background's petroleum engineering. So I was raised in Oklahoma around oil and gas, and very much, am familiar with that business. I joined Black Mountain because after the reason I went to business school was to try to pivot away from kind of that large corporate environment at ExxonMobil and start a company. And so on the back of HBS, I was introduced to Rhett Bennett, who's the founder and CEO of Black Mountain, and he's fantastic. So he's, at the time he was 35, had started 9 different companies in the oil and gas space and successfully monetized them. And I saw him and met him and said, this is who I want to learn from. This is my next step. And so happily moved to Fort Worth and joined Rhett actually as part of Black Mountain Oil and Gas. My title was Director of Business Development or something. I don't know. And so Rhett and Black Mountain are both incredibly entrepreneurial, always trying to identify emerging trends, emerging thematics, and capture that value, be kind of the first mover and have that first mover advantage. And so I joined Black Mountain in 2017, and already the writing was kind of on the wall around energy transition, and things were starting to change. You were starting to hear ripples of electrification, and we wanted to be able to make money on both sides. So especially at that stage, we didn't think oil and gas was going anywhere, but again, wanted to be able to make money on both sides. And so he asked me to figure it out. How can we make money out of electrification using our skill set? Go. Turns out electrification is very much a metals and mining story. And really, I read everything I could get my hands on, talked to everyone who would return my LinkedIn messages, and really dug into both battery chemistry, research within the battery world around where that chemistry was headed, and then starting to learn the fundamentals of mining. And so we landed on class 1 nickel sulfide and copper, really being the 2 core pillars of electrification and what we invest in.
So is that something you enjoy doing, going and tackling a new problem and trying to figure out, hey, let me find out what I don't know? You start out not knowing what you don't know, and then you find that out?
So absolutely. I love to, find something in the market that either hey, that doesn't make sense, or identify an emerging thematic that you don't understand. Those are my 2 kind of favorite items to dive into, because those are the items where you can really create a lot of value. So value is generated from disruption. I firmly believe that. And particularly right now, with all the disruption that's happening in broadly the energy space, there's a tremendous amount of value to be created. I love kind of getting my hands dirty, doing research, asking questions. And I really think it's really kind of a core personality trait of mine, is that relentless pursuit of knowledge.
Let me ask you this. So Rhett obviously had the background starting, monetizing companies. whenever you had this idea, was it difficult to go raise the capital? Maybe walk me through the capital raise process. I don't know if it's public information, whose your funding is from, if it's a bunch of groups, if it's one group. Had you done that before? And then, just walk me through that and how you guys went about it for this new venture, for the mining venture.
So I had never raised capital prior to Black Mountain Metals. Frankly, the folks we were talking to were all either oil and gas funds or oil and gas high net worth individuals. And it took a lot of kind of the education process and building awareness around electrification is a thing that's going to happen, because this was 2018. So, Tesla was still, the most shorted stock in the world, and EVs really hadn't reached that penetration rate. Renewables weren't a focus. So it really was a huge education process. And so the process did end up taking a bit longer than I think had we been more of a cookie cutter type investment that they've done before. They know how to play it. They know how to model it. That being said, I do think the folks that took the bet on us and backed us early on are really seeing dividends. Well, I know they're really seeing dividends now, but what I do think is those folks are particularly well positioned to ride this ESG wave going forward and to have already developed that core competency. Whereas at all the other funds and all of these SPACs and all this money that's being thrown at ESG, they're starting from square one. So they're starting back where we started in 2018. So first mover advantage.
Yeah, I'm fairly plugged into the oil and gas capital side. And it does seem like the ESG trend, you have to almost have some kind of slant, especially raising money specifically for an asset or even for blind pool money. You have to have a story there that at some level plays into that, or at least that seems like that's the trend currently. So you guys were a bit ahead of it, because right now that seems to be the main thing.
It is the thing right now. So I think for funds, LPs are really starting to demand it. LPs are very focused on ESG, very focused on climate change. And really how oil and gas and natural resources are going to stay relevant in the future. And so you're seeing that same dynamic in public companies. So shareholders are demanding action on climate change. And so officers of these companies have to fulfill their fiduciary duties and try to make sensible investments that you're checking the ESG box, but you're also continuing to make money. And I think, we're seeing a lot of things right now that it's silly capital deployment it's the classic case of folks deploying capital emotionally into things that they don't understand. And I think we're going to see a tremendous amount of burnt capital.
What I like about your approach is getting really to the source of what is driving a lot of this, the core materials, the resource that's going to be needed, versus maybe getting into the direct solar or, wind or something that is, more on that side of it. It seems like there's going to be a lot going into that. And so you guys are playing it like the base of that to supply that trend.
So I have two comments. One is, so the CEO of Black Mountain, his name's Rhett Bennett. He's from Kentucky, and he has a horse racing analogy that he always says, and I think it's perfect. So he said, on us playing electrification, we didn't want to try to pick the next best battery or, be the people out there designing a new chemistry, because that's very venture capital. And it felt like picking a horse on the track. If you win, you're going to win big, but your chance of winning is very small. We want to be the feed in the barn. So all the horses need to eat, all the battery chemistries need nickel. Like that is the constant. And so that's why we went out and made those investments. We want to be the feed in the barn and have more of that private equity style returns. Second comment, you highlighted solar and wind, which, hey, there is starting to be a lot more deployment on the solar and wind side. Live in Texas where, we have one of the largest shares of renewable energy in our electricity mix in the country, which I think is something that folks really don't appreciate. That being said, people who are going out and developing new solar farms or, new kind of wind energy developments, you are not making private equity style returns in any way, shape, or form. You're making like toll road style returns. And so it's a completely different capital base. Different players are going to chase it. And that's not where those oil and gas PE funds are going to pivot because you can't make money.
Yeah. So I'm glad that you talked about the private equity style returns and cost of capital and things. I was going to touch on this later. But right now, I mean, what we're talking about it. So you guys are targeting more of this kind of outsized return, be innovative, take a little more risk, but then you have that upside versus how you described kind of just the steady eddy, almost toll road dividend style with less risk, maybe take or pay type agreements. But that is the type of capital that you guys raise.
Absolutely. So all of the capital for metals has actually been raised from oil and gas high net worth individuals. So it's really interesting. It's folks who have made all of their money, all of their net worths in the oil and gas business, recognizing that like, hey, times are actually evolving and we need to get on the front foot and try to diversify our own net worths and our skill sets to be successful going forward.
One big thing that's a trend is sustainability in general. And I know you guys are playing that, but talk a little bit about sustainability with mining. And you're obviously conscious of it. And look, I'm not naive. Every type of energy has an environmental impact. It doesn't matter what it is. It doesn't matter if it's solar. It doesn't matter if it's nuclear. We all use energy, and any type of energy is going to have some kind of impact. So sustainability applies to everything. But talk specifically about you guys and how you think about it. Any thoughts there and what you're doing?
Absolutely. So I think a general trend in the market is that end manufacturers like OEMs of vehicles or battery manufacturers, as well as consumers, are really starting to care about their overall carbon footprint. So I think even 2 years ago, folks would go buy their electric vehicle and would feel good about it and say like, I'm doing a good thing. I'm moving the ball down the field. Like I am eliminating carbon emissions. That being said, if you look at the entire supply chain, if the OEM or battery manufacturer didn't certify that their battery metals that are going into their lithium ion batteries were mined in a environmentally friendly, ethically sourced, sustainable way, it's actually higher carbon intensity than just using oil and gas. So you're not accomplishing what you're setting out to do, which is truly a shame. So, this entire ESG wave, the downfall would be if folks only focused on one segment and just threw out the entire rest. So what we're focused on, and this is all the way back to when we made our acquisitions, is ensuring that we have some of the lowest carbon footprint nickel globally. And so, really what that means is there are kind of two different kinds of nickel. Well, there are three different kinds of nickel, but two we'll talk about. One is nickel sulfide and one is nickel laterite. Nickel laterite requires this entire extra processing step where you have to leach it with high pressure acid. So huge energy requirement, high pressure acid, and it is not friendly from an environmental standpoint. So we only acquired nickel sulfide operations and are very focused on minimizing that carbon footprint. And I think, overall, you're seeing all the major miners come out with new ESG policies, new carbon commitments. And I think where the world is going is you're going to see a bifurcation in the metals markets and the oil and gas markets around metals or commodities that were extracted in a low carbon way versus those that were extracted in the traditional sense. And I think you're going to be able to command a very real premium.
Where's the supply mix generally? If it was a pie chart percentage wise, where's it coming from just these different
Yep.
countries?
So if you're looking at nickel sulfide specifically, Russia is the largest producer. So Norilsk there, they have incredible deposits. They're nickel, platinum,
Yeah.
palladium mines. Second largest producer is Canada. So mostly the Sudbury Basin in Ontario, which is pretty much fully controlled by Vale and Glencore. So two of the biggest miners in the world. The third largest is Australia. And so it's a basin called Kimbalda, and it's very fragmented. It's owned by very small companies, which is why we saw that and thought that it was a good actionable opportunity.
So yeah, later I want to get into more about the specific assets and kind of the stories behind each. But what about the U.S.? I mean, I thought I read somewhere that maybe back in the 90s, early 90s, we were a larger mining player than we are today. Is
Absolutely.
that right?
Absolutely.
Tell me about how that has trended and why we are where we are
Yep.
today.
So the U.S. actually has some really rich copper deposits. There are some nickel deposits, but fewer. I wouldn't say we have like world-class nickel deposits here in the U.S. Um, there's been a very unfortunate kind of trend, specifically in the US, around being anti mining. And so what's happened is it has become incredibly difficult to permit new mines to the tune of it taking 15 to 20 years to get a permit to build a mine. No
Wow.
one's going to do that. Like, no sensible person is going to deploy capital into the US mining space when that kind of wait period is on the other side for you to be able to get a permit. It's actually very interesting dynamic because it's much easier to get an oil and gas permit to go drill a well here in the US. If you go to Australia, mining permits are actually much easier to get, and oil and gas onshore developments can take up to 3 years to get permitted. So it is like
Yeah.
it's just the inverse. And it's a real shame. I mean, you need to make sure people are checking the right boxes, doing the right things, being responsible. But in this new future energy world that we live in, the US is falling behind. So, we're not being, or we're not set up to be kind of energy independent in the future.
What kind of national security type implications are, everything this is batteries and technology and these things, the stuff you're talking about, but also rare earth and all these things we need. We can't get any of that stuff here. That doesn't seem like a positive thing.
So we have one large rare earth mine called Mountain Pass. It's in California, which it's bankrupted a couple of companies actually.
I think I've read about that.
Look, it's got a dramatic past, but I do think they've kind of sorted out some of the cap structure issues, and it seems to be performing well. From a national security standpoint, interestingly, the US and Australia share effectively a strategic minerals alliance. And so the US and Australia are a bit married in that way. And so, good news is Australia has a tremendous amount of mineral resources. They have rare earths, tons of nickel, tons of copper, like very blessed country. But it's not in the US. So, pick your interpretation of how foreign relations could change going forward. And, we could end up in a very real situation where, we don't control anything in the new energy economy.
How did this last administration, and with all the trade stuff that was going on, I didn't follow every country that we were dealing with. I do remember Australia in the news a little bit. How did that impact you guys, or did it?
Really didn't. Nothing that I can kind of tangibly point to and say like that really made the difference.
Right. Was there any concerns?
Look, I think more than anything, people like stability and people like predictability. Right. And in the last administration, we didn't get that. The kind of prior rule book, for better or for worse, like, like this is just a fact. The prior rule book had kind of been thrown out the window. And so I think people didn't know how to interpret that. Some people loved it and some people hated it. You can see that domestically as well.
With the new administration, any expected changes, or is it, you think that, I mean, honestly, I think this new administration is probably going to be more stable in a lot of ways. I mean, you've got somebody that's been in the White House. He's coming back into the White House. Do you expect any major things to happen, or do you have an opinion on
it? One thing I will say is there does seem to be a real focus on clean energy. I read a couple of days ago in one of my kind of morning news emails that President-elect Biden is requiring each cabinet secretary to have experience in combating climate change. So regardless of which group you're heading up, like Secretary of Defense, for example, needs to have a track record of combating climate change. I also read that they're either going to create a new cabinet position in a new kind of government body dedicated to climate change, or it will be like the NSA where it sits all the way across. So I do think you're going to see a lot of kind of proactive policies and implementations going in that regard. In terms of foreign relations, I mean, I would say the old playbook is back in, so back to kind of predictability and things of that nature, for better or for worse.
What about being a U.S. company and operating in internationally? And I know you did it at Exxon, and then now doing it here at your current venture. What are some of the complexities and things you have to deal with that? Is it? I mean, it's really outside of my area of expertise. So, kind of just give me some your background on it and what's it like.
Number one complication is time zones. Sure. Our Black Mountain Metals headquarters is in Perth, Australia. So on the West Coast, it's plus 14 hours from here. So effectively, I've become like nocturnal. So, wow. They wake up around kind of like 4 p.m. our time, and then are in the office from kind of 5, 6 p.m. So any calls that I need to have, they're in my evening time, well and truly. And generally, I kind of take calls until about midnight. So that's bizarre and like far and away the weirdest thing. I'd say the other things to just be cognizant of would be, kind of the tax implications and the currency implications. It's something I've really gained quite a lot of appreciation for. Interestingly, the US and Australia have a double taxation treaty such that you're not subject to taxation in both jurisdictions, which is fantastic because that would kill any economics. On the currency side, bit of a mixed bag. Like sometimes there's some positive arbitrage you can get. So commodities are paid in US dollars. So metal contracts are denominated in USD, which means you're being paid in US dollars, but your OPEX is going out in local currency. So in our instance, Aussie dollars. The Aussie dollar was like tanking for a couple of years as we were getting set up. And there was fantastic arbitrage because we had that uplift where we were being paid in USD and investing in USD, but Aussie dollars were really devalued. And so it artificially enhanced our profit margin, which was nice. Don't bet on that. Like that's no reason to go make an investment, but it was a really nice uplift.
That's really interesting. So yeah, and I want to talk more about that and the pricing around the products, and then also the currency stuff's interesting, but take a step back just around supply demand dynamics around the products that you mine, just macro. You talked about some of the trends, but it is undersupplied. Talk to me about just some of the supply demand, where it's at today, all these trends that you've been talking about. Where do you see it going into the future?
So right now, like if you kind of look at markets, they're pretty on balance. 2020 has been a very bad year for demand, consumer demand. No surprises there. Same dynamic in the oil and gas business. Interestingly, right, a lot of supply kind of got knocked offline in the metal space. So if you think about the difference in producing oil and gas versus producing metals, oil and gas once you've kind of drilled the well and have it completed and it's in production, it's much lower touch. So it's not like, it is dependent on 100 workers showing up every day and getting it out of the ground. So you didn't have the supply disruption due to COVID. You had the supply disruption due to oil price going negative and people shutting in their production. Mining, there were, numerous instances of COVID infections at mine sites. You have to completely shut down and suspend all operations. The kind of biggest example of that I can think of is some of the large copper mines in South America. So you had a very real situation where there was just not enough copper out there and price really increased. In the future, no doubt, we need more metals to come online. People need to start developing new mines. And they are.
Where's the primary source? Is it Russia? Is it some of these other countries you mentioned? What do you think the major driver? Yeah, or just copper and nickel?
So nickel, so Russia, Canada, and Australia are the largest current producers of nickel sulfide. Nickel pig iron, which is called class 2 nickel, and it's not suitable for batteries. It only goes into stainless steel. That predominantly comes out of Indonesia, Philippines, and China. So class 2 can be ramped up basically infinitely. Sulfides, really, really hard to find new sulfides and bring new mines online. So I don't anticipate kind of the country mix of where sulfides come from to change substantially. On the copper side, very much a South America story. Chile has a tremendous amount of huge copper mines, operated by kind of the majors. So BHP, Rio, Vale, et cetera. And so, I think you'll continue to see that. Australia is also a massive copper producer, as is India. So you kind of have a bit of a mixture in there.
So with all these dynamics going on, what's the M&A and kind of the transaction market for this stuff looking like? Has it been slow? Has things been slowed down because of COVID? Or is there a pent-up demand? Is it I know in oil and gas, it's hardly anything going on, right? Because there's the bid-ask is very wide, a lot of uncertainty. Is that carried over with what you guys are doing?
Not as much. So deal activity has certainly slowed down due to COVID because mining is such a global business and you want to be able to diligence assets. You need to go there and see it and send your team and look and, kick the rocks and figure out what's going on. And you can't do that right now. So deal flow has slowed down. The one exception being gold. So this year, gold has rocketed to the moon because of all the volatility, all the risk, and gold just being a good safe haven metal. There has been a ton of gold M&A this year. M&A, mergers, a lot of deals getting done. I'd love to own a gold mine.
Specifically on these, well, I'm going to go into the assets in a second. Before we go to that, talk a little bit about just on the selling the products and the marketing. I have an energy marketing background, primarily natural gas and oil. So I know how those products are traded, how the index prices are and how it's all works. But I don't know for what you do. Do you guys sell to, I know you probably can't disclose your actual markets, but in terms of direct end users, is it middle markets? Is it a mixed? Is it long-term contracts, short-term contracts, spot prices? How do you hedge it? I'll just talk to me a little bit about that side of it.
Excellent questions. So specifically, well, actually, I'll take a step back. So broadly, metals are traded on the London Metals Exchange. So the LME sets global metal prices for every major metal. So if you want to know what a ton of nickel is going for, you just Google LME nickel and it'll tell you what today's pricing is.
Okay.
So what happens is, if you have nickel concentrate, there are kind of three main end markets that you can sell it into. Generally, they're quite long-term contracts, kind of 3-4 years, and you're locked into those, and then your concentrate will come back up for marketing, and you'll kind of rebid it out and identify new customers. The three groups of customers are 1, nickel smelters, 2, traders, and 3, battery manufacturers and OEMs. So that third group is like brand new to the nickel market. And it's really an interesting dynamic because what we're seeing is OEMs are reaching very far up the supply chain, much further than they have historically, and are sourcing their own metals as opposed to letting kind of a middleman do it, because they're very focused on ensuring that they're mined in sustainable ways so that these OEMs don't get the blowback of buying metal from like a horrible mine in the Congo or something similar.
Going to the specific assets, maybe walk me through the deal origination. How do you identify these assets? And then the specific assets that you own, if there's any stories behind those, how you originated it, how you got the deals done. I think I read something about a hostile takeover, which sounds really exciting. I'd love to hear some about that.
It was an adventure.
But just maybe walk me through these assets that you have, how you acquired them, and some of the stories behind that.
Absolutely. So earlier I walked through kind of the core nickel sulfide producing regions. We identified that Kimbalda had actionable opportunities, Kimbalda being in Western Australia, because it was owned by a series of kind of small, much smaller nickel miners that, maybe you could strike a deal with or to do a takeover, and not large cash balances. Like, it seemed kind of actionable. And so when we initially went to Western Australia, there was actually a formal sale process on the asset that we own 100% of. So it's called Lanfranchi, which is a nickel, copper, cobalt mine. Fantastic mine, right on the Kimbalda Dome. One of the larger mines in Kimbalda. Very clean concentrate, no arsenic. Really good MgO qualities. So it's very desirable concentrate. So it was important to us to get that as a first step. The second thing we did, so I'll use kind of oil and gas analogies, but so mines, you bring ore out of the ground, but you can't just like ship ore around the world. You need to go through a midstream processing plant. So it would be like putting it in a pipeline and sending it away. The midstream processing plant on the mining side is called a concentrator. And so it does exactly what it sounds like. Like, let's say, ore comes out of the ground at like 3% nickel. You send it through a concentrator, and through a series of flotation and kind of other sorting mechanisms, it comes up to maybe 20, 30% nickel in slurry. You can then put that on rail, put it on a tanker. Like, that's what you ship around the world to sell. And so the second acquisition we did was around having access to a concentrator, because we wanted to control our own destiny. We didn't want somebody else owning the one pipeline out of the Permian and being able to put whatever terms they wanted on our ore, and making us unprofitable. So we acquired kind of a smaller stake in a publicly listed company called Poseidon, and then acquired their convertible note, which was owned by Jefferies Leucadia. And so that was the beginning of a very drawn out kind of acquisition story. So we, positioned ourselves such that we, were bought in. We were serious. We were a major shareholder. We owned all of their debt. Like, we are locked and loaded, man. And so we sent an offer to the board of Poseidon. They completely rejected it, said like, no, not good value to our shareholders, which I very much disagree with. And like, we'll still argue that to this day. But, they were like,
Sure.
Nope, not good value. We're not going to put it to a shareholder vote, like not going to do any of this. And so we launched a hostile takeover. And so ended up, really long story, but ended up getting up to 21% of the company, and then firing everyone who had been on the board previously and putting in competent people who will actually represent the best interest of shareholders and not be selfish and try to manipulate people who are trying to buy the company for their own personal gain. And so when you do a hostile takeover, it plays out a lot in the press, because the reason you have to go hostile instead of like a friendly takeover is, if it's an agreed takeover, the board will put it to a shareholder vote. And the board has to say, like, I support this or I don't. The goal is always to like make a takeover as low drama as possible, get it put to shareholders with board support. And we couldn't get past like the first step. So we just went straight to the papers and basically outlined our case for why this was good value for shareholders, and why the board was not acting, not holding up their fiduciary duties and weren't acting in the best interest of shareholders. And we were right. So the shareholders spoke. And so again, that company looks a lot different today than it did then. And we have a fantastic management team in place, great corporate controls, good governance. So I'm really proud of what's happened there.
So these assets that you've bought, do they already have existing management teams in place for each one of them? In both instances, did you buy those assets and then keep the management team in place? Are you guys more of a, like the investor that then listens to the management team, or are you actually hands-on managing these assets?
So Land Frankie, we hands-on manage. And we have our own team that I hired. I love, they're fantastic. Like I dare you to go find a better hard rock mining team than what we've got. I have all the faith in the world in them. And so they hands-on manage that asset. The 21% we own of Poseidon is managed through the Poseidon management team, which again, after our hostile takeover, we rolled the board. And so everyone on the old board was dismissed. And shareholders, all shareholders, not just us, got to choose the new management and leadership for the company, including a new CEO who's fantastic. Importantly, that company has had a tremendous amount of exploration success this year. They have the highest grade underground nickel mine in the world and effectively have found another deposit of that high grade nickel sulfide. And so we're super happy with the progress that's been made.
That's awesome. Are you still in growth mode, or are you in harvest mode with what you have right now?
Good question. So, we'll never say no to a good deal. It's just oftentimes value expectation. It goes back to bid-ask spread. Oftentimes, I think value expectations, particularly in a commodity like nickel, bake in future upside for electrification. And so the prices that management teams want are completely out of whack with what current nickel price is today. And so it's really hard to shake loose assets at a price where you're actually going to make money. And so we don't want to buy stuff just for the sake of buying stuff. We only want to buy things if we are confident that we're going to make money. So I'd say we're still in growth phase, but just nothing has been incredibly compelling since our original deals.
I was going to ask around the metrics for the M&A and how it's viewed, if it's cash flow based, if it's steady, if it's a growth multiple.
Yep.
Is it primarily, is the growth multiple volume driven, or is it price driven? Because you've got these different levers that can grow future EBITDA, and it sounds like these are based off growth and people expect to be paid for growth.
So something interesting that's very different to the oil and gas space is there's effectively no private equity in mining. Everything is the public markets. Everything is done on the public market. So either the ASX or the TSX for the most part. And so if you're trying to make an acquisition, it's based on market cap. So whatever the public believes it's worth, plus a premium. Premiums can go from, I don't know, let's say reasonable premiums are 25 to 50% premium on top of market cap. And so, we have our own benchmarks of what makes a good deal in terms of multiples on reserves, in terms of cash flow, in terms of exploration upside, et cetera. But ultimately, the only way you're going to get a deal done is if you pay an adequate premium on a market cap.
So in the areas that you operate specifically, let's not talk about these other countries. Is it like the US where you've got different plays or different geographic areas? And then within those areas, you've got a bunch of mines, a few mines. I guess how many bunch of mines. So there's a lot of actionable potential deals in terms of
Yep,
churn.
yep.
Would that be a
That's
fair
exactly
statement?
right. So the city where mines are, it's called Kalgoorlie, and it's one of the like great historic mining cities. And so Kalgoorlie to mining is what Midland is to oil and gas. Like it is the
Gotcha.
bread and butter of mining. When you fly into the airport, actually, two things about Kalgoorlie. When you fly into the airport and you come out, there's this big sign that's like Kalgoorlie, streets paved of gold, which is actually true because what they do is they use tailings from mines, so the waste product, to pave their roads. And inevitably, there's some metal that's retained in tailings. So they actually do have like gold and nickel
Wow.
on their streets, which is
Yeah.
cool. The second fun fact about Kalgoorlie, there's something there called the super pit. I think it's like the largest open pit mine in the world. I don't know that that's 100% right, but it's this huge open pit gold mine, now owned by a company called Northern Star, which they're like the gold standard of any mining company, but particularly gold miners. And when you're flying into Kalgoorlie, it's like the most recognizable feature is this like giant open pit mine. And they that's like the number one tourist attraction in the city is you can go down, take tours, check it out. Like they have lookout points. I mean, it's very mining centric. So there are a ton of mines in this area, predominantly nickel and copper in this region. Or I'm sorry, predominantly nickel and gold in this region.
And I probably should have done this research beforehand, but what area of Australia is this
So
in?
it's in Western Australia. That's the state. Western Australia is just the entire western half of Australia. So it's like a massive state. It would be like if west of Oklahoma, it was nothing but San Diego, literally. So in San Diego is Perth. And so all that openness in the rest of Western Australia is like all mining activity. So tons of iron
Yeah.
ore, tons of everything. And so our mines would be like northern Arizona. That's kind of where Kalgoorlie
Yeah.
Kempalda is.
It's a good description.
There we go.
So talk a little bit more about the logistics around, I've got a midstream background. So you talked about kind of close to the mine. You've got sort of the midstream, as you've described it, this processing, and then you go a little bit further downstream. Let's talk about, maybe just describe the different facets all the way to the end markets, but then also talk about contractually, how does this work? Do you have to dedicate a mine to a certain provider? Are there very limited options to where you're kind of captured by these different things, these different providers? What are the rate structures? Are they locked in? Are they flexible? Just walk me through how all that works.
So concentrators are definitely the pinch point, and that's a processing plant. So it's usually like a hub and spoke model. So there's like one concentrator surrounded by a bunch of mines that fill that concentrator.
How hard are they to build? Is it a long lead time? Are they really expensive?
Both.
Is it capacity can be expanded easily? Is it hard to expand?
Hard to expand, hard to build new ones, expensive to build new ones. So in about 250 to 300 million US dollars. So they're expensive. And particularly for some of these smaller, scrappier mines, you are not going to deploy that kind of capital to have a dedicated concentrator. And so the steps are you mine the ore, you put it in trucks, send it to a concentrator, it gets concentrated. The slurry is then either put in trucks or on rail to either, depending where you're selling it. So if you're selling it to a smelter, BHP is the only nickel smelter in Western Australia, and you can either truck or rail it to their nickel smelter. Or you put it on a train down to Esperance, which is a port in the south of Australia. And from there, you can send it anywhere globally.
If you were doing a netback model, you'd have basically the transportation from the trucks. You'd have fees involved with the processing. You would then have transportation out of that to and where's the custody point? Where do you sell it at typically? How far downstream do you sell it?
Fully variable. So it all is dependent on the marketing process, which is why it's really critical to get a great marketer. Same in oil and gas, but our kind of commercial VP for Black Mountain Metals, her name's Samantha Richardson, and this is what she does day in and day out. Like, monitor these contract terms. If when you're going through an offtake bidding process, it's the smallest little details that could make or break the economics of your mine. So where exactly the custody point is it the port? Is it the other port, like the destination port? Do you have to pay shipping costs? What percentage of LME are you getting? What kind of penalties due to kind of deleterious elements like arsenic are you getting paid for byproduct credit? So like copper, cobalt, precious metals, oftentimes you aren't. So that's just like thrown away value. So it's fully dependent on individual contracts. There's no like standard.
Are there people for the smaller mines? That's obviously a lot to manage. Do people come all the way to the mine and buy it at the mine? Do you have to get it further downstream to be able to sell it? Are there middle marketers or the people that come in and try to arbitrage all that?
So you have to concentrate ore. So the first sales point would be out the back of the concentrator. And that happens. Yep. But you really wouldn't just like buy the ore at the mine. Okay. You need to get it to the concentrator.
Right. And so the concentrator agreements, they are like a fee based off of weight. How does it? I don't even know how you would charge fees. I know you do barrels and you do MCF, MMBTU, but how do you?
Yeah. So usually it's like a volume tolling flat fee.
Okay.
So for every ton that goes through, you're charged X dollars. Right. But again, there's no set standard. So everyone has a bit of a different way that they look at the model.
Yeah. Do they make you guys do commitments? Do you have to enter into any kind of like take or pay? Like you got to show up with a certain amount or you don't get paid or you don't get to, and if you don't show up, you have to pay the fees either way.
Exactly.
How do you manage that? That's a pretty big liability to.
It's a huge liability. So it's all about mine planning and ensuring you have contingency to, make sure you show up at the right time with the right amount of metal or you're in trouble. So it's all about operational planning and efficiencies and making sure your ops people are communicating well with your marketing people.
Yeah. What is the lifespan of these mines and how long they can produce?
So Lanfranchi, the mine we own, has been around since the 70s and has been producing really strong the whole time. There's actually a mine in Western Australia that Herbert Hoover was the mine manager for, like our Herbert Hoover, and it's still in production today. But there are some mines that are just, smaller deposits. It would be like some oil and gas fields are bigger than others. And so some wells can produce for longer, and things of that nature. So it can be a couple years, it can be 100 years, just fully depends on the geology.
Yeah. Do you own a lot of, I want to talk about labor and equipment. Is there a lot of equipment that you own that you guys carry on your books? Do you lease a lot of equipment? Do you contract the labor out? Are these employees of your company? Walk me through some of that, the operations side.
Yep. So Western Australia has world-class mining contractors. They're very much a mining economy, but their mining contractor market is like second to none. I can think of very few companies that can do a better job mining in-house and like buying all the equipment, hiring all the personnel versus just hiring a mining contractor who comes with the people, trained, all the processes, all the standards, comes with the equipment. And that's where we're very much a contract miner. And you would find most people are.
Yeah, that makes sense. So in game, I think I've dug into most of the kind of just the details here that I can think of, just right off the top of my head, but that's really helpful. That's all interesting stuff. What about in game for you guys? like a lot of private equity, is it a monetization? Is it an operate, cash flow, pay out investors kind of a dividend? Is it just whatever makes the most sense? Or can you share?
Yeah, we're super flexible. So like we're a very entrepreneurial group, very opportunistic. If somebody came and made us a good offer, like sure,
Yeah.
I'm not in the business for my health. If somebody wants to pay us for it, that's fantastic. But base case is always, cash flowing it out and making good money.
Awesome. Well, that's a lot on mining, and I've learned more about it today. I feel like I know a ton more than I did before this podcast. So let's talk a little bit about, you have some natural gas operations as well, and want to talk about that. Also, I know there's something net zero natural gas. Maybe talk about that as well. But first, let's talk just about in general, high level, what you guys are doing, and then we'll kind of walk through like we did with the specific assets, and then maybe talk about this net zero natural gas.
Yep. So we've turned our Perth office into a platform, like Rhett had done with the Fort Worth office historically. And so we have Black Mountain Metals, which is our battery metals mining company, and then Black Mountain Exploration. So we own 1.7 million acres of natural gas in Western Australia onshore. We bought it from Mitsubishi, own and control 100% of it. It is technically a supergiant resource. So one of the kind of few supergiants left undeveloped in the world. We really like it. It has some of the lowest carbon intensity nat gas of any undeveloped reservoir in Australia. And so why that's important is Australia is the world's largest exporter of LNG. Their main customers being South Korea and Japan. Both South Korea and Japan have come out and said they want net zero LNG going forward. So that means scope 1, 2, and 3 emissions completely offset, such that you are sitting at zero basis on carbon being released into the atmosphere. And no one is entirely sure where to start with that, how to tackle that challenge. But what has been made clear is they'll pay a premium for net zero. So if you can crack the code, you're going to make more money and you're going to be completely differentiated in the market. So what we're doing is we're actually making our Canning Basin asset the world's first net zero natural gas development. So what that means is we don't sell LNG. We're just planning to sell natural gas, but it makes that hurdle much lower for LNG folks to process our nat gas through their trains and then sell the LNG on the back end. And so that's really our competitive advantage and really, how we feel like we're moving the ball down the field, making natural gas truly a transition fuel.
So is this tight gas? Is this shale rock? What's the reservoir?
It's tight gas, basin-centered tight gas specifically. And so, we control a huge portion of the basin. But something that Rhett, the CEO of Black Mountain, always likes to highlight is this is tight gas, not shale. So we're orders of magnitude more permeable than the stuff that we're left drilling in the US. Couple that with Australian gas prices are way higher than US gas prices. So you're talking kind of oscillations between $6 to $12. I mean, huge, like much more elevated because you're tied to Asian LNG markets. So it's great.
Yeah.
So we're kind of well and truly in the processing. We're well and truly in the permitting stage of our project. And we're looking to bring fully into production in 2027. So it is a much more long lead project, but what that means is we're working with a blank slate so we can really get on the front foot and make it what we want.
So are these horizontal drilling, vertical drilling? How is this developed?
Horizontal.
Do you know like
horizontal.
The depths and the lateral lengths or any of the technical stuff? Do you know how deep these wells are? Just asking.
Not off the top of my head.
Yeah. And
yeah, we're actually going through our EPA referral process right now. So in Australia, so that's actually, there are a ton of public documents out there about the wells we're planning, the fracs we're planning, exactly what's going to go down hole, trying to be really transparent. But unfortunately, I don't know that off the top of my head, Matt.
Is it,
Sorry.
no, it's fine. Is it Is it dry gas? Is it liquids rich?
Dry gas, which I know in the US, you're like, oh man, it's so nice to have that liquids economics
Yeah.
kicker. We are in a very isolated place that has limited infrastructure. And so we prefer kind of one thing to get out and sell. So dry gas from that perspective is really attractive.
Yeah.
There's a bit of condensate, but really not enough to kind of mention.
Yeah. Look, you need the whole petrochemical complex and processing and all these things. And that there's a lot there, a lot of long lead time stuff. What about midstream? Are there pipelines accessible for this play that you guys are in? Or it sounds like 1.7 million acres. That's a big footprint. You're going to need a lot of pipe, I'm guessing.
Absolutely. So it's actually something we're working through right now. And so stay tuned. Everything is very much on the commercialization side, progressing in parallel around pipe out of the basin, commercialization option and end market. So a lot of balls in the air, but I think over the coming months, we're going to have some exciting.
Yeah. Is that in the same vehicle or a different vehicle? Did you guys raise something specifically for that asset, or was it out of a?
Yep.
Okay.
So Black Mountain actually doesn't roll up into a single mother company. Every company we start is completely separate investors, separate cap structure, everything. So they're completely separate entities. We call them sister companies because there are commonalities in the management team, but from an investor standpoint and ownership standpoint, they're different.
On that one, it's basically you got this long lead time. Do you guys think you'll see that all the way through? Is it a play where you kind of tee it up and then pass it off potentially to somebody else? Given where it's at in its life cycle, it seems a little more wildcat ish versus some of this mining stuff that a mine that's been around since the 70s. This is something where you're like, I'm incubating this. Is there that opportunity to then get it to a point to where that's maybe the exit? Or you don't know, maybe
we're cowboys out there. Yeah, no, for sure. It definitely is on the polar opposite of kind of the asset life or asset age perspective. Again, we're a really opportunistic group, and we're not married to any outcome. So right now, base case is like we're operating this thing and we're taking it through. But again, always kind of open to talking about stuff.
Sure. So moving from that, and I don't know how much you're involved with it, but high level, anything around I don't know much about the stuff in the lower 48. You guys do have assets and you do business in the U.S.?
Yep. I actually am not really involved in any of the U.S. entities, which is so funny, but I'm just the international person. So we have Black Mountain Oil and Gas, which is domestic oil and gas, and Black Mountain Oil and Gas 3, and then Black Mountain Sand. Those are still two active companies here.
So we've gone into a bunch of detail about the specifics of the businesses that you're in, and I feel like I've learned a lot. But now I just want to back up a little bit, maybe a little less technical. I want to ask everybody this, any just stories that you want to share just about your career, things, whether it's a crazy deal, which I know that hostile takeover was a great story, but just any other good stories that you feel like from your career that you'd like to share.
Look, that hostile takeover story was the one I had teed up to tell today. I will say just broadly, it's very funny to see the differences in the kinds of characters that play at like the oil and gas space versus this like junior small mining company that's public space. So you definitely get a lot of characters coming out of the woodwork. And certainly, I think I was shocked by how many like not legitimate companies are publicly listed and actively trade and promoted. So I have found it to be very entertaining over the years, and would certainly encourage anyone to go to this website called Hot Copper. It's like a gossip like message board. And it's every publicly listed ASX company has a dedicated site on Hot Copper, and investors and brokers and spruikers and everybody go and like talk about what's happening at the company, and announcements get posted there. there are the wildest things that come out of hot copper. So sometimes they're spot on, and sometimes you're like, I don't know what world you came from. So go to hot copper, pick a random company, and enjoy.
Yeah, it sounds kind of like the oil and gas Twitter. There's just some like parody accounts. There's also some just like people on there that are dropping all these bombs about stuff that's going on at whatever company, and you're like, is this real? Did you see on this Twitter? Like why? Yeah. So where I'll end it is, what about your future? I mean, you got this great venture going on. It sounds like you're checking a lot of the boxes that you wanted to check from going to grad school and then moving on. Super loaded question, but are you happy doing what you're doing? Is this what you wanted? What do you view yourself doing into the future? Something along this, but for me personally, sometimes it's like you check a box and you get to this moment where you're like, what's the next thing that I'm going to go do? Loaded question.
Look, it's totally fair. So I don't know the answer to that question. I don't know what is next for me. What I can say is like the variable that is locked in is I love the energy business. And I think whether it's 5, 10, 50 years down the road, I will be involved in some form or fashion in the energy business broadly. I love to be kind of on the innovation side, being a forward thinker, being a kind of thought leader, if you will, and trying to like push the ball forward. I also kind of like that feeling of being like on the leading edge of changes that are happening. So I would hope that, those themes stay constant in my career. I truly believe I'll kind of be an entrepreneur for the rest of my life. I have no idea what job I could do after this craziness that has shaken out the last 3 years that would feel fulfilling. So I think I'm doing this just somewhere else in the energy business.
Well, thanks so much for you've been a fantastic guest. This has been really interesting. I'm glad you came on the show, and I'm excited to see not only what you guys are doing, I'm going to follow it now, and not just that, but also you personally. So again, thank you so much.
Awesome. Well, it was great to meet you, Max, and thanks for tuning in.
All right.